Hello friends, I am Siddharth and today I am going to talk about the long-term capital gains tax in the debt-oriented mutual funds. In my earlier videos, you must have gone through the meaning of what is capital gains, what's the meaning of capital gains tax regarding the equity and the debt and the short and long of it. Now in this video, we will be going about the long-term capital gains tax on the debt-oriented mutual fund. What are the rules surrounding it? How do we calculate? And how do we make use of a facility called indexation to lower our tax outgo? Do you want to pay lower tax? I am sure that most of you or all of you would be craving for it, isn't it? So let us learn about this beautiful facility called indexation. On the screen, I am showing you an example regarding your investments in a debt-oriented mutual fund scheme. So herein I have taken this data as if the original investment which you have made some 3 years back or 4 years back in a debt mutual fund scheme, the amount is as 1 lakh rupees. And after completion of 3 years, 4 years, means after quite some time, your value of the fund is 1,25,971 rupees. I have written here against this line the word called redemption value, or you can understand as if you are just seeing the current market value of your investment. That is almost equivalent to the redemption value. If you've already taken your money out, then it is known as redemption value. Otherwise, if you are just seeing the valuation of your portfolio, then you can just assume that this is the market value which I will get if I take my money out. So here in this case it is 1,25,971. So that means a capital gain of 25,971 rupees after 3-4 years. Now would you like to pay tax on this 25,971 rupees? If you don't know about the existence of this facility called indexation, then you will end up paying tax as per your tax bracket on this 25,971. So if you are falling into 30% tax bracket, then you will pay 30% of 25,971. So what if I give you a solution called indexation? Not me actually, it is the income tax department which allows us to do so. That if you want to become a smart investor, then you should know these rules. Indexation simply means that you can increase your cost of purchase. You have invested although 1 lakh rupees from your pocket. You will be showing in your accounts only 1 lakh rupees as your initial investment. But the income tax department rules, they allow you to increase your cost of purchase artificially by the rate of inflation. Not that CNBC inflation rate which you see in the CNBC channel, I mean to say. Herein you are talking about a special inflation index, or the rate known as the cost inflation index, or in short form we call it as CII. Cost inflation index is published every year. So for 2013-14 financial year, it is published every year by the income tax department. 2014-15, 15-16, 17-18 and so on and so forth. So for every year, once in a year, index is published. So for all the years, you will find the index data freely available, easily available on the income tax department website. Lots of other websites are also there, plus you can find them on the income tax books also. So you can see on the screen, I have taken cost inflation index for the year of purchase. Actually, I purchased this investment. I have done this investment in the month of May, year 2016. So that is why financial year I have written as 2015-16. And the cost inflation index for that year, which I have taken from the records, it is 254. Similarly, now when I am selling it in the month of May, year 2018, that the financial year is what? 2018-19. So whenever I am buying, whenever I am selling, my first job is to see that within what financial year that particular time point is falling into. So in this case, the financial year is 2018-19, and the index, cost inflation index, I mean to say, for this year of sale is 280 rupees. So income tax department simply says that since I have invested, or you have invested 3 years back 1 lakh rupees, and now you are coming out with some capital gains, but in these 3 years inflation has also increased, so I allow you to increase the cost of purchase artificially and pay tax on the lower amount. That's the whole idea about it. Now let us see how do we calculate the increased cost of purchase. The formula is given on the screen. Cost inflation index for the year of sale in the numerator, divide by cost inflation index for the year of purchase into the original cost of investment, original cost of purchase, I mean to say. So if you if you put 280 in the numerator, divide by 254 in the denominator into 1 lakh rupees, that is your original cost of investment, you will get 1,10,236. This is your increased cost of purchase, otherwise known as the indexed cost of purchase, artificially, although you have invested only 1 lakh rupees, isn't it? Beautiful. Now let us see what will happen. Of course, we all know that capital gains is real amount is 25,971, but due to this indexation, my capital gains amount has come down to 15,735. How did I arrive at this amount? It is simple. 1,25,971 minus 1,10,236. I hope you are getting me. So my capital gains amount is now 15,735, and now I am supposed to pay a flat 20% tax on this capital gains amount. So 20% of 15,735, that gives me amount of 3,147. This is the tax I am going to pay, and rest of the money I am going to take home. How much money I am going to take home? 1,22,824. This is my post-tax returns. Had I not been aware of this facility called indexation, either intentionally or deliberately, then I would have ended up paying tax as per my tax bracket. So if I fall into 30% tax bracket, then I will pay 30% of 25,971. I hope you are understanding this, that if you do not make use of this facility, you will end up paying higher tax amount. So if you like to pay lower tax, or if you want to lower your tax impact, your tax outgo, then you must understand this kind of facility called indexation, especially in the context of debt oriented mutual fund. This facility is not available in the case of equity oriented mutual fund. Only for debt oriented mutual fund it is available. But the point to be noted here is that if you want to use this indexation facility, there are certain criteria. I'm going to summarize the entire this thing. Example I've already shown you. The criteria is that, first of all, the scheme about which you are talking, the scheme about which you are going to implement this calculation, it must be a debt oriented one. And when you will be using this facility, what's the trigger? Trigger is that your investment date and your exit date, between these two time periods, between these two time points, you must be crossing 3 financial years. 3 financial years means 3 times you should be crossing 31st March, 31st March, 31st March. So in this example, as I told you, I purchased this investment in the month of May year 2015. So I crossed what? 31st March 2016, I crossed 31st March 2017, I crossed 31st March 2018 also, and then I took out my money in the month of May 2018. So 3 financial years I have crossed. So now I am eligible to use this facility. If any of this criteria is not met, even you might have invested for 3 years, but somehow due to the date and month of your investment, you are not crossing 3 years, 3 financial years, then you will not be entitled to use this facility. Then you will pay tax as per your tax slab. So you must be able to time your entry and exit accordingly, of course with some capital gain. So this was all from my side, friends. I hope you have understood the concept of long-term capital gains tax on the debt-oriented mutual funds using the indexation facility. See you in the next video, guys. Thank you.